Assalamu alaikum, everybody, and thank you for joining us today. Inshallah, we'll be going through a quick mid-year market update. We have myself and Irfan both presenting today. Irfan is a portfolio manager, and I'm an associate portfolio manager at ShariaPortfolio Canada and ShariaPortfolio Global. We will have the presentation, after which we will leave the floor for a couple of questions if anyone does have any. During the presentation, if you do have any urgent questions, feel free to put them in the chat box. There's a Q&A chat box, and we'd be more than happy to address them. Yeah, so we'll just get right down to it. Quick disclaimer for all those who are watching, standard procedure before every webinar. I mean, it's just basically saying that we're a portfolio manager registered in Ontario, Alberta, BC, and Quebec, and information shared here is not for any investment advice. It's more for educational purposes. We'll go through a quick overview on the regional outlook, after which we'll discuss the market portfolio performance in general and the drivers and laggards of our portfolio. And then we'll touch a little bit on sector analysis in terms of how our models are being managed. And we'll then look at a quick outlook for the second half of 2025, and Irfan will give us some insight on that as well. For those who are new, who are joining us today, a quick overview on ShariaPortfolio. We're Canada's only licensed portfolio management firm fully dedicated to Sharia compliant investing. We're registered as a portfolio manager in Ontario, BC, Alberta, and Quebec. SPUS was formed in 2003 in the USA and is licensed by the SEC in the US. Our accounts are custodied with Fidelity Clearing Canada, ULC, in Canada. So, get to the meat of the presentation. Start off with the regional outlook. To quickly kind of look at the US, Europe, and China and how things are panning out right now in the economy. In the US, the economic growth in the second half of the year is expected to fall below trend. And a lot of this is because of trade tensions that are going on, tariff wars, headline news. But despite all of this, the stronger consumer income base in the US can actually potentially help avoid a recession. Inflation is likely to pick up, and this is largely due to tariffs that come into play. And this could potentially have an impact on inflation rising, and it may cause the Feds to actually delay cutting rates. We will see today at 2 p.m. what the Feds do, but there is a 98% probability of today's rate staying unchanged. US GDP growth forecast has also been downgraded to 1.3% from a prior estimate of 2%. In Europe, ongoing trade policy uncertainty is expected to continue to weigh on economic performance, despite Trump actually having said over the past weekend that they've come closer or come to a deal with the EU. Despite all of that, near-term GDP growth may slow slightly, but a rebound is anticipated towards the end of 2025. At the end of the day, broader geopolitical issues still have an impact on the economy, not only in Europe, but also the US. With China, their outlook is shaped by several things. One of the main things surrounding the Chinese economy is trade uncertainty, and largely due to US tariffs and discussions between the US and China with regards to this matter. At the same time, innovation is playing a huge role. For example, DeepSeek, which was launched not too long ago, which actually challenges a lot of the investment made by North American companies into AI. Domestically, expectations for further policy stimulus have been tempered for now, but weakness in the housing market has also resurfaced, adding some more pressure to the Chinese economy. Compared to the US, GDP growth in China is also projected to slow down, with a full-year growth estimated at 4.8%. In terms of US equities, if you look at the graph on the right-hand side, this is the S&P 500 past year-over-year earnings growth and the consensus forecast. You can see that the consensus forecast for 2025 is actually lower than what it was for 2024, and then it rises back up in 2026. Earlier this year, we had a very volatile stock market, especially due to the tariff headline news, causing a pretty steep drop in the S&P 500, but we have since recovered the entire drop. The risks from tariffs appear to have calmed down compared to the impact they were having earlier in the year, but the average US tariff rate is still higher than usual, and the impacts are still yet to be seen on the economy. There is still headline news risk with regards to tariffs, but the uncertainty is not as high as it was earlier this year. For example, the VIX index is actually close to its lowest in the past year, 2 years. Economic growth is expected to stay below average in the next couple of years. As I mentioned, the 2025 end of year outlook is actually lower than it was in 2024. And interest rate cuts could resume in the fall, potentially shifting investor focus to 2026 growth, which, even if moderate, could help support markets. Given the ongoing risks and the fact that we're in a period of high stock valuations again, with the PE being at an average of 27, we believe it's best to keep US equity exposure at normal levels and not too overweight. You may have noticed this in our increase in our position in SPWO over the past couple of months, which is our ETF, which gives us exposure to the global market. In terms of policy rates, like I mentioned, we're going to see what happens at 2 p.m. today with regards to the Fed announcement, but there is a 92% probability that the Feds are likely to cut only between 25 to 50 basis points by the end of 2025. When this happens is yet to be seen, but that's what the market is pricing in at this point, a 25 to 50 basis points cut by the end of 2025. Let's look at the market performance and the drivers and laggards in our portfolio. Before that, just going to give you a quick overlook on the different models that we have. As you see on the screen here, at the bottom left is our Sukuk model and the conservative model. The further down on the left and bottom that you are on this graph, the less the expected volatility in your portfolio, but the less the potential returns as well. On the top right, you will see the aggressive model, which has the highest position in equities compared to conservative, and the least exposure to Sukuk and real estate. Once again, and I like to mention this during a lot of the webinars that we've had, considering a lot of the times we've been at all-time highs. But a lot of you as investors may be asking yourself, okay, is it too late to invest? We're at all-time highs. Should I still invest right now? What's going to happen next year because we are at all-time highs? Well, this graph actually helps putting things into perspective. What is the probability that the S&P 500 is higher following investment at a market high? So we're at all-time highs right now. If you invest right now, what's the probability, considering history dating back to 1950, of your investment actually being higher than currently over a 1 year, 3 year, 5 year, and 10 year period, considering the fact that you'll be investing at an all-time high? If you look at a very short term, which is a 1 year period, what is the probability of the S&P 500 being higher than it is right now? And that's 73%. We had a webinar not too long ago before the beginning of this year where we were at all-time highs, and I shared this same graph exactly. And a year later, we are actually higher than the all-time high that we were at before, which keeps us in line with these statistics being proven correct. So over a 1 year period, you have a 73% chance still of being higher than the current levels. For most of you who are long-term investors who are planning for retirement, you're looking at a 10-year period. Over a 10-year period, there's an 87% chance, which is a very high probability, that the S&P 500 would actually be higher at the end of that 10-year period. So this is important to be able to keep perspective and maintain that long-term vision when investing, especially when you go through periods of volatility and downturns in the market. During the first half of 2025, the S&P 500, as of June 26th, did about 4.46%. which is really good considering the downtrend that we had during the first half of the year, during the first quarter of the year, let's say, where we bottomed out around mid-April. A 4.5% return, considering the situation, volatility, the tariff headline news, is amazing. But I'd like to mention that based on our Bloomberg model return data, our aggressive model actually performed about 9.7%. And that's a phenomenal outperformance of the S&P 500 during this first half of the year. And we'll get into why. Now, in our model, in our aggressive model, we actually have our top 5 laggards, which is our top 5 drags in the portfolio, as well as our top 5 drivers. The drags are basically the stocks which have limited our returns. And we take a look at that as well as the returns that are impacted by the drivers. So when we look at the laggards here, we've got 5 main ones. We've got Novo Nordisk, we've got CRM, we've got CNQ, Adobe, and BDX. So Novo Nordisk is in the healthcare sector. It's a market leader in diabetes and obesity treatments. They've been a very volatile, but also it has been a drag on our portfolio for many reasons. They're a fundamentally strong company, but they've had a lot of headline news coming out with regards to, let's say, their relationship to HIMSS. Recently, their decrease in their forecast for earnings over the next year. And it's something that we're actually looking into very deeply right now to consider potentially liquidating. Sorry, there's an error on the screen here. It says Novo Nordisk liquidated. It's not liquidated yet, but it's something that we're in discussion and looking at this very closely to see if we have any other opportunities to move out and reallocate capital from Novo Nordisk. But as a company, it is still a good company and strong fundamentally. It is a market leader in the industry. So there is a chance that we may actually decide to continue holding it, but that's to be determined. We will let Irfan kind of add some thoughts on the laggards before we move on to the drivers. But
No,
let's look
thank
at the
you.
next one. Yeah, Irfan, you know what? You can go ahead and add some thoughts on Novo Nordisk
Yeah,
because you're
no,
more.
Novo especially because recently there is a change in leadership in Novo as well, and their earnings are still, I think, August 5th or 6th is their earning announcement. So they're facing a competitive pressure in the markets. Despite being a market leader, and generally in these circumstances, market leaders tend to benefit. But in the case of Novo Nordisk, the Danish company, so there are some uncertainty in regards to tariffs on the European Union, 15% tariffs, and competitive pressures from compounders, basically, which are selling it at a discount. Initially, that thing started when there was a shortage of Ozempic in the States, and FDA allowed HIMSS to kind of uh, be able to sell its non-branded product instead of Ozempic. So all these factors we are looking at, and stock had a dive actually after the change of management, and there's a press conference there, which I think was very poorly handled by Novo Nordisk's management, and part of the reason is like that caused a headline sell-off in the stock. Stock still, company is still fundamentally great company. It's a market leader in obesity drugs, and it's likely to remain as a market leader. And we shall be discussing weighing pros and cons of that, me and Zishan and other members of investment committee. Uh, Even today, and we'll see like if that's warrants a further holding, or we need to. Our thesis on that is there's the opportunity cost. There are many disciplines we follow. One is the opportunity cost discipline. One is the target price discipline. Then third one is a deteriorating fundamentals. Like we'll discuss it from those angles. And if there's a need, then we will try to replace it with a better holdings there instead of no Nordisk. Uh, Other stocks which was mentioned like BDX, obviously, there are some issues have been in regards to the earnings in the past. There's a guidance issues on the guidance. Adobe, great company, again a market leader, agentic AI, but we have some issues there that because again the management has not been that great in handling investors' expectations through their reach outs. So the stock price has been very underwhelming there. So despite being a great company, so these are three or four of them actually we think definitely needs we will be looking at in this month, and we will making it seen on these laggards. Thank you, Zishan.
Thank you, Irfan. Yeah, I mean the other one is Canadian Natural Resources. In terms of this one, it's been a laggard in terms of price return, but it is still a strong holding across actually all of our models. It is Canada's biggest energy company. They have 32 years of energy equivalent reserves, and they provide a very strong dividend yield for a lot of our investors. And it's something that is a laggard in the portfolio, but at the same time, it's something that has a lot of potential upside, which is why we still hold this, as well as the fact that it gives us exposure to the energy sector on the Canadian side. So yes, like Irfan said, these are all companies that we look at very closely and actively make decisions on what to do with it. But yeah, we're yet to see what happens, and we'll keep you updated as we go on throughout the rest of the year. Then we go to the drivers. In terms of the drivers, we've got Transmedics, which is also in the healthcare sector, but has done really well this year. We've got Bitcoin, which gives us an exposure to kind of a different asset class in our portfolios and some higher level of diversification. We've got Verisign, which is a very strong company, Taiwan Semiconductors, and Snowflake. With regards to Transmedics, they're again a very strong company fundamentally, very strong revenue growth, and they've performed really, really well this year. If you look at the graph here, they've done 110% since the beginning of the year, compared to, let's say, the S&P 500, which has done 4.5% during the same period of time. That's a phenomenal performance for a company in the healthcare sector like Transmedics. It's something we continue to hold and continue to keep an eye on to see what to do with it. In terms of Bitcoin, we got in at a very good key level technically, and we continue to hold this in the potential of some more upside. But at the same time, one of the main reasons for holding this is also because it gives us that level of diversification and exposure to a different sector and a different asset class, which can gain momentum very quickly. Verisign is a very, very strong monopoly-like company, and they're known to operate the .com and .net domain registries for which they have very, very long-term leases. It's a company that's very strong fundamentally, has a very strong business model, and a very strong revenue model in terms of its subscription-based clients. And it's also a very high margin company. This company has actually done very well this year as well, with about a 39% return. And it's something that we continue to hold. And it's something that can provide very strong returns for our clients over a long period of time. Then you have TSM, which is actually up 90. TSM, sorry, that one is not completely accurate. It's up 15% year to date. It's in the semiconductor industry. We have exposure to semiconductors in our models, but if you may have noticed over the past 6 to 12 months, we've actually decreased our exposure a little bit to this sector. But TSM remains one of those companies that is a core position in that space. It has very strong potential for increasing gross margins, and it's also a large player in the AI theme in that space. So we continue to hold TSM right now, and we look to see what happens with it throughout the next half of the year. We've got Snowflake, which is in a similar industry as Adobe and CRM in the software side, but Snowflake has actually performed really well this year as well. It's got about a 44% year-to-date performance, and it's something that has actually helped our aggressive portfolio outperform the S&P 500 in general. If you look at the next slide here, this is a table that pretty much shows you the contribution of a lot of these stocks that we've just mentioned in terms of the laggards and the drivers and how they actually perform and how they contributed to the performance of our aggressive model. So if you look at the top side of this table, that's the drivers. Considering our weight in the models for these individual companies, the performance contribution towards our aggressive model performance is about 7.9%, whereas on the bottom, you'll see the laggards, it's actually contributed to close to negative 3% of the return. So you can see that our drivers actually have a larger impact on our model performance compared to the laggards, which is something that you want to see, right? Every pick that our portfolio management team will not be profitable in terms of returns, because that's pretty much impossible to do. But what you want to see is that the ones that are working out in our favor are doing much better than the ones that are not working out. And that's exactly what this table shows. It shows you the contribution to the performance of the companies that do well compared to the contribution of the negative performance of the companies that didn't do as well. So I'll just let you guys take this in a little bit because some of you may have questions for this at the end of the presentation before we move on to the next section. Okay. When you look at sector analysis, this is something that we look at very closely in terms of how our models and our performance is exposed to different sectors compared to the S&P 500. For example, if you look at the graph on the left, that is as of at the end of the year 2024. You can see, for example, on the consumer defensive side, we were underweight compared to the S&P 500 by 4.3%. At the same time, on real estate, we were overweight by 5.5%. Now, what we've done here is we're showing you the difference in our weighting compared to the S&P 500 from the end of 2024 to our current positioning, which is mid-2025. Here, you'll see kind of the changes we made. So for example, if you look at communication services, we were underweight, and we're still underweight compared to the S&P 500, but we did increase our position in communication services. For example, Telefónica Brazil and VeriSign are two of our biggest holdings in the communication sector. And those are both companies that have actually outperformed the communication service sector as a whole, which did 8.98% during the first half of the year. On the consumer discretionary side, we were underweight and we're still underweight, but we actually decreased our position. And that's a good thing because if you actually look at consumer discretionary as a sector, they're negative 2% for the first half of the year. On the consumer staple side, again, we were still underweight compared to what we were at the end of 2024, but we did increase our position slightly. On the energy side, we were overweight, we're still overweight, but we decreased our position. So if you actually look at this, it makes sense because that's actually a sector that didn't perform as well compared to the other sectors, and we did decrease our position throughout the first half of the year. Two of the major changes that you may see are the materials sector. So on the materials sector, we were overweight at the end of 2024, and we are now underweight the S&P 500 on the materials sector. The performance has been positive, but due to the positions we were holding in terms of the companies and the adjustments we needed to make, we are now underweight materials. On the tech side, we were underweight because tech was something that we had a very large exposure to. But now we are slightly overweight compared to the S&P 500 by 1.3%, which is not too much, but we're pretty much in line with the S&P 500 in terms of exposure in the tech sector. Irfan, anything you want to add to this? You're on mute, Irfan. Irfan, you're on mute.
Sorry, guys. So, no, thank you very much, Zishan. You've done covered it very well. Just wanted to add that about the real estate sector, we went overweight on that during this time between end of last year and mid-year. And part of the reason is like there's still an inflation threat in real estate. Hard assets are best portfolio hedge against the inflation in the U.S. Although the fear of that is still not that predominant, but still its probability of that happening is still there, especially if you look at the last read. Yeah, that's kind of like just one addition. I would just wanted to add my comment here. I think other than that, this Zishan, you covered it very well. You can move
Thank you,
on.
Irfan. So we'll move on to the next section. And Irfan will give us some insights and what our 2025 second half of the year outlook looks like in terms of our portfolio, where we see the economy going, and a couple of more details. Irfan, I'll leave you to it.
Thank you very much. So the positioning, there's some positioning, some changes here. This is a broad asset class level discussion here. That at the asset class level, when we look at the portfolio construction, this is the U.S., Eurozone, Japan, basically Eurozone, Japan, and emerging markets, all they get lumped into, except for if there are some ADRs there, but mostly that exposure is taken through SPWO. Then the second dimension of looking at the things is I wanted to keep it simple. My last end of the year slide for this was slightly more complicated and included the commodities separately as well. So, but in this, we just we just have the two dimensions. One is the style dimension, with growth versus value, quality, large cap versus small cap, cyclical defense. Uh, Whereas in the case of the regions, the second dimension is the regions. So I think as Zishan mentioned here, that Europe is slightly less. These arrows, blue arrows, shows that where the positions have changed since the start of this year. The U.S. has still, I would say, either equal weight or overweight, despite some concerns on the valuations. But I think U.S. Because of the strength of the U.S. consumer side, and that's really, and the tariffs generally, if I would call that, and the recent GDP growth numbers for the first quarter, which came at around 3%, was much higher than the expectations. So that's panning out that way. So I think that's our stance there is validated on the US. Our stance on the emerging markets is also validated there. They are equal weight as per kind of, I would say that MSCI World Index, if you look at that from that angle, we probably would like to be have a significant and decent exposure in Japan and Eurozone. Eurozones have weakened a little bit because we were slightly more positive on that uh, at the start of this year, but because of the tariff regime and also I think the cycle, the interest rate cycle, interest rate cut cycle in most of the economies, Eurozone, um, US, and China, that has run its course for the time being. And I would say that 2 p.m. Fed's announcement would just validate that. Prior to that, Bank of Japan has announced a stalling on raising the rates. ECB has announced they are stalling any further rate cuts. So all these factors. So any upside in the on the valuation from cutting the interest rates for the higher valuation stocks in the Eurozone, basically, that's almost done, have taken place already. So earnings growth wise, I think the US companies still are better off. And I think that's the where the focus is. We are looking at the earnings where the earnings are good and outlook is good. We still feel that quality, which or Sharia compliant investing style is, it tends to be select those stocks. We tend to select those stocks which have lower debt. They have higher business statement quality, which includes obviously the cash flows to revenue ratios, uh, which also encourages to select those companies where the asset turnover is higher so that the cash and cash equivalents as a percentage of the assets are much lower. So that imbues a higher quality to the stocks we select in the portfolios. This quality as a sector has performed very well in the last 3, 4 years, and it seems like quality would uh, will be the best performing factor in the second half of this year as well. Uh, we did not want to, we had some discussion on the growth and value themes at the start of this year, and we felt that yeah, there had been growth had a strong run actually in the last few years. And maybe there's a contrarian argument for value, but I think growth versus value is immaterial at this stage, although I think there is still a potential with growth having a certain edge or value in the second half of this year because of the AI adoption benefiting the bigger companies, bigger growthy companies, much more than the value companies, which are traditionally old economy companies. Uh, Next slide, please. So these were some considerations when not all of them actually, there was a similar slide at the end of last year, and we probably will retain that. That basically a thought process when we look at the macro level, at the higher level for the portfolios. Bull market, we still think that it's not bull market still it's working, and there is less monetary policy support now for this bull market going forward, especially in the second half of this year. Uh, Spreads and earnings, I would say that will should do the heavy lifting here. So all those companies where the earnings are and the guidance is better, those companies, so it may be a stock picker's market, and that's where you rely on us for as a stock pickers to keep selecting the good positions, basically, which would benefit the portfolios rather than taking a broader market view on the overall the stock market itself. Although I think I was going through the research reports that a lot of uh, sell side houses, research houses, they are of the view that there is some upside in the beta as well, with the broader S&P 500. There is some upside. Their earnings per share is has been revised downwards in the first half of this year, and there's a potential around 10 to $12 upside there on earnings per share, which can be added to that as a surprise in the second half of this year. And that's what it may result in, like 5 or 6 percentage points from earnings growth to S&P's performance in the second half of this year, even if there's no support from the further valuation expansion. Although valuation expansion, there's an argument that it can be, there may be some valuation expansion like price to earnings expansion, like which is currently at maybe 22, somewhere around 22 levels. So because on the relative basis that the best market, the US still stays the best market, so there's a argument that valuations or price to earnings can as well expand by 4 or 5 percentage points. But having said that, their second dimension here is the small cap versus Max 7, basically, are EFE versus US China versus Max 7, Huawei versus NVIDIA in the terms of chips manufacturing. There's Tesla headwinds as well. There's challenges to AI algorithm and the semiconductor complex. As Zishan briefly touched on, that we reduced our exposure to semiconductors in the first half of this year. And part of the reason was that there was uh, after the DeepSeek announcement, there was a potential that there were two factors which came out from there. One was the energy intensity of the data centers, which reduced, uh, which conceptually reduced the need for higher electricity consumption for the big data centers, and hence reduce the need for bigger energy plays in whether coming from nuclear, like uranium stock CCJ, which we sold in the first half of this year, or from the nuclear power producers, which uh, potentially we otherwise would have taken a position if that DeepSeek turning point would not have come, which has changed the algorithm and reduced the energy intensity of the data centers in the AI space. So all these discussions flow into our still will flow into our selections, additions as well as deletions from the portfolios. Um, I think still, although adoption is higher in Meg 7, but in the AI adoption and the productivity gains there could result in some expansion in the margins. But I think the upside in the small caps, small and mid caps, SMIDs, uh, they would be substantially higher than Meg 7 in the second half of this year. Uh, US probably would be still a better play in the second half of this year compared to EFE and EM. Um, and we shall be wary of, I think we should be cautious about the semiconductors where the inventories are high, although Trump has tried through his Middle Eastern trips for NVIDIA to be able to sell its H100 semiconductor chips to Qatar and UAE, which would really reduce some inventory there from higher end chips. But the overhang is still there, and we need to be pretty cautious on that on the semiconductor front. Not so much for the companies like AMD and Qualcomm, but the companies which are at the top of the uh, value chain like NVIDIA and TSM. Uh, the sectors which are taking a lead and which have lagged the rest of the S&P 500 they are like healthcare sectors, which has not really performed well in the first half of this year. It's a laggard sector, and its valuations is much more attractive compared to all other sectors and S&P 500 in general. So, and it's one of those sectors where margin expansion will be much more profound by AI adoption. Scheduling is another angle which I was looking at, optimization, quantum computing, all these some of these names where there's a very strong potential for margin expansion and revenue generation from AI adoption. So we shall be taking kind of our eye on the themes, these themes, and the stocks which are going to be best representative of these themes. Uh, the counter consensus, this is basically counter consensus, which I mentioned earlier, and S&P getting $9 to $10 additional EPS in the second half of this year. There's a risk there. Stagflation is still a risk that economy stagnates and there is a higher inflation, especially coming from tariffs, which has not materialized so far. Although the last inflation print, CPI print, was higher than expected. There are some advantages on deregulation and industrial overcapacity in China, which is mainly deflationary in nature, so which can absorb a lot of tariffs. Uh, Fiscal measures as tax breaks, they are generally also inflationary in nature. But on the other side, any any job cuts which will come in the U.S., that should be deflationary. And these are all those factors which will add to second half volatility. On the macro risk, global geopolitical risks, obviously, Russia is and Ukraine war is one risk which is really outstanding there, and which can cause a turmoil in multiple sides. Basically, China is a part of that because if U.S. imposes sanctions or starts pumping in the arms to Ukraine, that may result in as we recently saw today, I saw this news flow that Trump has put additional sanctions, additional tariffs of 25% on India for purchasing Russian oil, and also threatened to put 100% tariffs on China if they do not stop buying Russian oil. Uh, that's a potential for oil price. We have some exposure to oil here. I know some of our investors just were asking us this question, why do not we reduce our oil flavor? That's why we do not, because those factors are still there, and there's a potential there that oil price really can increase because of those risks there in regards to Ukraine. Middle East is another risk. Um, the best geopolitical hedge in both these risks, I think particularly Ukraine and Russia, is oil. So then another angle of that is obviously currency risk because India may join in with the rest of the BRICS to kind of trying to reduce their reliance on the US dollar for trade. Um, so the currency hedge, probably the Bitcoin is one of those currency hedges which is represented in our portfolio. Uh, Although gold can be discussion that gold can be added as a part of the portfolio as a currency hedge, but I think I was going through the Gold World Gold Council's report, and it seems like it's the central bank purchases for gold is petered off, and gold at this price is pretty toppy here, and there are uh, further on the production for supply side, there are more supply coming in from multiple places in the world, which is potential to increase the global gold supply to maybe almost 5 to 10%. So, which can bear down on the gold prices. So that's a tricky hedge, and that I think that's not a neat hedge for a currency risk at this point in the short term in the second half of this year. Uh, yeah, I think currency scenes reverse carry trade risk has is there, although that's Japanese yen versus US dollar that has really trailed off a little bit because Bank of Japan has announced they are stopping further rate hikes. So the whatsoever rate hikes they already made, basically that's a rewinding uh, the the carry trade, which included borrowing in the yen and investing in the US dollar or US treasuries. So that has panned out for a little bit in first half, second half probably is less so. Uh, Deglobalization would stay as a theme. That's another angle. So I don't think that's going to go away with the tariffs and everything. They are going to still be there, and we will be wary of that, and we'll be watching that, and we will be keeping that as a portfolio consideration for selecting the stocks which are more resilient to deglobalization themes. Next slide. So yeah, these basically are some of the practical, this is a flow from the previous slide. So which some positions we have already taken, some positions we are considering, some positions I have not considered. I have not considered that. I have not considered that these would be some of the portfolio thoughts process as a part of the H2. And we still feel that, we have strong position in data centers, we have healthcare, although we probably will be tweaking some healthcare here, maybe replacing some healthcare with the other healthcares. We have real estate, which is a inflation hedge and to counter the portfolios for the risk in the second half of this year or maybe earlier part of 2026 as well. Uh, so we have exposure to AI adoption as well. We got out of power shortages thing in the US, as I mentioned earlier. Uh, we have some US consumer inflation. Calmain is one of those names which is there as well. Cybersecurity, we shall be looking at some themes. We have some of the financial transactions themes in the PayPal in the portfolio, which is a market leader and is launching its own stable coin. And it's a lately, I think the couple of the names which we were tying was a Block versus PayPal. Block has done relatively better compared to PayPal, but Block has done it for not for the fundamentals, but for its inclusions in the index, S&P 500 index. So PayPal's kind of like in the second half, probably it seems like what should do better compared to Block. Uh, so yeah, I think I shall leave it there with two things. The disciplines, the self discipline, the buy discipline. I've not listed them as a reason, but just the thematic at the thematic level, I think cybersecurity. We should have some exposure to cybersecurity, and we should have some exposure to space. We kept searching for that good names there. Some of the names which came up which are Sharia compliant, they were more speculative and were not suitable for the portfolios. We'll keep looking at those if we're finding some of those names which are uh, offer a better value to the portfolio and Sharia compliant and not speculative, then we will definitely try to find something in the cybersecurity and the space as well. Next slide, please. So these were again translation of the same themes. I think some of that is mentioned by Zishan earlier. Asset class level, what's our approach? We still think a risk on. Although I think market is pretty high and there may be some give back from market, yeah, especially in the month of August, first part of August, there's a potential that market may have there may be some profit taking there. Uh, but still, that does not change the strategic view, uh, which is basically comes from the beta positioning that we are underweight, we will stay underweight on cash and interest rate, and we remain overweight on equities at asset class level. Beta risk to reward is probably shifting to the stock selection. Uh, Besides that, there are some tech themes which I've already mentioned, emerging markets consumption. I've not touched upon, but consumer discretionary spending in India and China, which will be more resilient to uh, deglobalization, which is going to stay there, and their exposure to the higher GDP growths in both those countries. Commodities, I've touched briefly on oil and gold. I think there are some commodities which shall be industrial metals. I think we've stayed underweight, and we probably would have some a thoughtful discussion on that as we go because we took some profits from copper, uh, some of the one copper name we had in our portfolio. I think I shall leave it at that. The bottom table here is that is to show the correlations. Correlations is another angle. We look at some of the names and themes, how well correlated those themes are. We like to have all the themes or all the regions who have very low correlation with each other in the portfolio. That's the standard textbook practice in the portfolio management. So I just wanted to highlight that as well as another angle when we are structuring the portfolios so that portfolios are not overtly exposed to the high risks. So I shall leave at that and she'll hand it back to Zishan for asking for questions, please.
Thank you, Irfan, for your insights. I hope that for all of those who have attended, this has been beneficial and you found some value in the presentation today. You found the insights that were shared by myself and Irfan as helpful in hopefully managing your own portfolios or just to get an idea of how we are managing your portfolios and the thought processes behind the decisions that are made. We will now leave the floor open for any questions. You do have our contact information on the screen here as well. If you'd like to reach out to either myself or Irfan, feel free to do so at any time, and we'd be more than happy to help. If you do have any questions, you can add them into the Q&A chat box, and we can go ahead and respond to those. If I don't see any questions in the chat box, it means that Irfan and myself did a very, very good job, and we covered everything that could potentially be covered.
Either that or we were pretty boring.
I mean, a market update is always very heavy in terms of technicals and information that can be boring, but I hope we did our level best to keep you
No,
engaged.
no, I think Zishan did a very good job in going through the portfolios and exposing the portfolios and different angles of the portfolios and how we selected them and how we discussed that. So thank you, Zishan, on that.
Irfan, I don't see any questions, which means we did do a very good job indeed.
Okay.
So I can leave it at that. If you do have any questions that you'd like to ask us later on, like I said, feel free to send us an email, Irfan at ShariaPortfolio.ca or Zishan at ShariaPortfolio.ca, and we'll help you with those. With that, I'd like to thank all of those who did join us today for the webinar. Appreciate it, and inshallah, we'll see you at the next webinar.
All right. Assalamu alaikum
Oh,
then.
sorry,
There's
Irfan.
one question, I believe.
One question.
Yeah.
Do you want to answer that, Irfan? Can you describe an estimated conservative return?
Well, I think we that's a part of our investment policy statements. So I would say that 6% is the generally a conservative portfolio should even probably can be less than that. I think 5 to 6% is the conservative portfolio should yield.
Yep. I'd add that in general, a conservative portfolio, the target rate of return is let's say 4 to 5%, but our conservative model over a 5 year period actually has a return, like Irfan mentioned, of about 6 to 6.5%. So that is a very good performance return for a conservative model. I hope that does answer the question. I'll give it another 10 seconds if we have any more questions, and then we'll call it there. Perfect.
I think that's
Thank
about
you once again,
it.
everyone, and inshallah, we'll see you at the next webinar. Thank you,
All
Irfan.
right. Assalamu alaikum.